What if I told you that the secret to building wealth isn't in chasing the next big thing, but in making small, consistent decisions that pay off for years to come? Most people don't get there because they fall for the hype, the shortcuts, and the distractions. They think it's about getting rich quick when really it's about staying invested for the long run. They jump into whatever everyone else is talking about instead of doing their research and forming their own strategy. But what if you could avoid the common pitfalls and set yourself up for real, lasting financial success? Stick with me, and I'll share the 5 key principles of smart long-term investing that can set you on a path to real wealth. Alright, let's dive into principle number 1, patience. In the world of investing, patience is more than just a virtue, it's your greatest asset. Now, I know it's tempting to try and time the market, trying to catch that perfect moment to buy low and sell high, but here's the harsh truth. Most people who try to time the market lose out in the long run. They end up buying high and selling low because they panic at the first sign of a downturn. The real magic happens when you play the long game. Think about it like this. You're laying the foundation for a home. It doesn't happen overnight. It takes time, consistent effort, and most importantly, the right mindset. By investing regularly and letting your investments compound over time, you're positioning yourself for wealth that doesn't require you to check your portfolio every day. Trust the process and let time do its work. You'll thank yourself later. Principle number 2, diversification. You've heard the saying, don't put all your eggs in one basket. But let's dive a little deeper. Imagine you have your money all tied up in just one stock. Now let's say that company faces a major downturn, or a scandal comes to light. Ouch! That's a huge hit to your wealth that could take years to recover from. The key to reducing risk is diversification. Spread your investments across different sectors: stocks, bonds, real estate, and even international markets. Each of these asset classes carries different levels of risk and potential reward. By diversifying, you're minimizing the risk of a single event wiping out your portfolio. It's like planting a garden with different plants. If one plant doesn't thrive, the others can still flourish. You're protecting yourself from a total wipeout. And speaking of risk, that brings us to our next principle. Principle 3, risk management. Smart investing isn't just about finding the next hot stock or betting everything on one company, it's about managing risk. Think of risk management as the guardrails on the highway, helping you stay on track and avoid disasters. You wouldn't drive without a seatbelt, would you? Now, this doesn't mean you should be afraid to take risks. Every investment carries some level of risk, but the key is understanding and managing that risk. It's about knowing how much risk you're comfortable taking and making investment decisions accordingly. A solid investment strategy will balance higher risk, higher reward investments with safer, stable options. It's about creating a cushion that protects you when the market gets bumpy. Protect your wealth, don't just chase returns. Principle 4, consistency. This is where most people mess up. They invest for a few months, get discouraged by market dips, and pull out their money. That's a fast way to lose your wealth and your confidence. But if you stay consistent, even when things get tough, that's where the real magic happens. That's where you see the power of compound growth. Remember, wealth isn't built in a day, it's built over years, even decades. You need to invest regularly, whether the market is up or down. Think of it as watering a plant. Some days you'll see growth, some days you won't. But over time, with consistent care, that plant will thrive. Your investments are the same way. Tune out the noise and focus on the long term. Now, the final principle is the one that will make all the difference in your investing strategy. Principle 5, financial goals. Investing without clear goals is like driving without a map. Whether you're investing for retirement, a down payment on a house, or your children's education, setting clear financial goals will help you stay focused and motivated. It gives you a target to aim for and helps you stay on track when things get tough. Take a moment to think about your financial future. What do you want your money to do for you? What kind of life do you want to live? That's your why. Every investment decision you make should be driven by your goals. The moment you're clear on your goals, you'll see that every dollar invested becomes a step closer to your dream life. Start today, because your future self will thank you. There you have it, the 5 key principles of smart long-term investing: patience, diversification, risk management, consistency, and most importantly, setting financial goals that drive you. The road to wealth isn't a sprint, it's a marathon. If you want more tips to help you build a better financial future, hit that subscribe button, and let me know in the comments which principle you're going to apply first. And remember, the best time to start was yesterday. The second best time is now. Thanks for watching. Stay smart, stay invested, and I'll see you in the next one.